you're starting to get into real estate, whether it's investing or buying your own home, condo, or co-op, and you just don't know where to get started. So listen, one of the first places you need to get started is the 3 C's, and that's credit, capacity, and collateral. So what does that mean? Let's talk about your credit. You have different aspects of your credit. You have credit age, you have credit history, and then you have utilization. So credit history is just the length of time you've had any active credit available to you. The utilization is the percentage of credit that you actually use. Let's say you have a credit limit of $1,000 and you use $100 of that credit. You have a 10% utilization. So you want to keep that at a certain rate, but we'll get into that later. And then your credit history is actually, if you have late payments, just your overall activity and the history of that activity over the span of time that you've had that credit. You're going to get a score based on all these 3 factors, but that's not the end of your credit profile. That's not the end of what comprises your credit, because when you're going to get a mortgage particularly, you have to have a strong or robust credit profile, right? You have to have certain things in your credit profile. And those things are usually about the amount of credit or the capacity of credit that you can handle. So what does that mean? If you have a credit card for $1,000 and you pay it on time, you may have a very good credit score if you maintain that line of credit very well. But $1,000 in credit that you've been handling will not equate or guarantee that you can handle a couple of $100,000 mortgage. So this goes into your credit profile, where you may want to get more credit cards to show more capacity, or things like student loans or auto loans or personal loans for higher amounts shows that you have the capacity to not only handle your credit card payments, but other loan payments or installment payments as well. So you want to build out a robust credit profile that makes the steps to you getting a mortgage logical based on your credit history. So now let's talk about capacity. Your capacity is just your ability to pay something back. And in a mortgage sense, your capacity is demonstrated by your job or your income. So they want to look at your capacity, how much money you make, how much money you spend, how many other obligations financially that you have that would infringe or make you qualified or disqualified for a mortgage. If you have housing payments and credit cards and you have utilities and all these different things, those factor into your capacity. Now, if you live alone or you have a lease in your own name and you rent your own apartment, that's a good thing, because that's going to kind of give you credit or demonstrate that you can handle your living expenses or your housing. And if you're going to move into this property that you're looking to get the mortgage for, or that housing expense is going to go toward your ability or show your ability to cover that part of the mortgage. Now let's get into collateral. Collateral is basically any asset or cash that you can put up to offset the mortgage. Listen, when a bank gives you hundreds of thousands of dollars for a property, they want to know that you have skin in the game, meaning that they want to know that you invested just like they did. And that comes in the form of a down payment most times. Now, if you don't have the money or the cash right up front to make the down payment, any other asset that you have that you can liquidate to put toward a down payment and covering any other expense that you may have to get the mortgage would be great. Now, this capacity is not only for your down payment, because if you're in a great position financially, you have good credit, you may be able to qualify for a lower down payment mortgage. So that's not the only money you'll have to come up with. You're going to need money for reserves, because the bank doesn't only want to know that you can pay the mortgage, they want to make sure that you can be able to maintain the property, because the last thing the bank wants to do is give you a loan for a property and have to take the property back. So that's going to be your capacity. Your capacity not only to put down a down payment, but to maintain this property financially so the bank doesn't have to take it back. So that's a quick overview of the 3 C's, and this is where you start before you apply for a mortgage or going through an application process. This is what your loan officer is going to be looking for as the first steps to see if you qualify for a mortgage. So if you're new to real estate and you're looking to get into real estate investing, check out my Real Estate Investment for Beginners guide, okay? This is an essential book that covers all aspects of real estate investing. You can find it here. You can find the link in the bio.